Today I'm going to present Tower International. Tower International is a US company. It's a global stamping company. Basically what they do is body parts, doors, chassis, floor pans, and complex assembly of auto parts, welding basically. It's a 570 million market cap company with an EV of 870. Around half of the revenues from the company come from the States, 40% from Europe, and we've got a remaining exposure to Brazil and China. As you can see, well, they manufacture parts for 170 models of different kind of cars, and they are quite diversified in terms of clients. It's true that the main three clients represent 50% of revenues. Ford is the first client with 22%, Volkswagen and Chrysler. But as you see, except for Renault, they work basically for all the major OEMs internationally. I'm going to fly around the history so that you can understand much better the company. In 2005, these guys filed for Chapter 11 because they went really heavy on M&A, and they got a 1.7 billion net debt. To give you an idea, this is a 2 billion revenue company with around a 200 million EBITDA. In 2007, Cerberus acquired the company. They fired all management and they hired people from Ford. They IPO'd the company, raising 81 million with a sound balance sheet of 2.2 net debt to EBITDA leverage, and they sold the remaining stake at around $21 per share in 2013. It is now trading at 26.5. In 2015, they got a couple of significant contracts that will result in a 6 to 8% growth in the next 2 years. So that's important to see the visibility we've got in the medium term. Forbes ranked Tower as the #1 most trustworthy company in the US. Maybe you ask yourself why I'm putting this. Well, many of you won't know the company. It's a small cap in the States, so I guess this gives you more confidence to know that these guys are straightforward and do things properly. Also, Ford awarded Tower with the Top Global Supplier Manufacturing Award, and the main KPI, these guys are good in what they do. The main operational KPI is a 0.001% defect rate. This is a best in class in the industry, and is key to get new contracts and to not fail in the contracts they already have. They've always delivered in results or over-delivered. They have been selling assets in emerging countries, and we are now in an important year for Tower International. Basically because the CEO retires by the end of the year, and he has put on top of the table the potential sale of a major asset, which is Europe, which we will talk about in a while. In 2017, they have set a guidance for 2017 of a 5% conversion of sales into free cash flow, and this is the first key idea of the presentation. This implies an 18% free cash flow yield on equity and 12% on enterprise value. We are a bit more conservative, and we get down to 14% on market cap and 11% on enterprise value. This is what the stock did since the IPO. As you see, had some trouble in the first couple of years, then it spiked and Cerberus sold, and from then on, well, not much. So let's get to how these guys manage their company. These guys are always talking in terms of cash and leverage. It's a cyclical company. They know it, so they want as few risks as they can. They've got a 1.2 times net debt to EBITDA by the end of 2015. As you see, the covenant is far away, so not many risks. And this 1.2 times is the real leverage. I mean, there are no other things. In fact, there are 70 million in those around 250, 300 million debt if you account for pensions as well, which are tooling. What is tooling? When these guys get a new contract, they have to invest in tooling, in a bit of machinery. So they pay for that. But it's an investment that the OEM makes. So they are advancing payments for the OEM. And this tooling, in a couple of years, they get it back. So it's a zero sum during the life of the project, or in the first 2 years. They've got a lot of liquidity, around 370 million. From those 370 million, 140 is cash, and the rest is unused borrowing. And as you see, maturities are far away in time, into 2020, when we believe, and assuming that the company as it is now, that they will pay down debt, or they will have a net debt to EBITDA really low by that time. Moats. It's an unsexy sector. It's an unsexy business. There's not much technology here. There's operational excellence, but there's something else. Contracts are long-term. You have to do the plant attached to your client, to your OEM. So the OEM doesn't have much flexibility to start switching suppliers. That's the first point. With your operational excellence, what you are avoiding is that the OEM decides to change from supplier, which is weird but has happened, and at the same time you have a better image to bid for new contracts. And there's a key issue here, is that OEMs are outsourcing the stamping business. Why? Because it's capital intensive. Capital intensity, we think it's an important moat. What new competitor is going to go into this business? There are guys doing it, the sector is concentrating, you need a lot of capital, you need operational excellence to get new contracts. And the model might be more resilient than what you think. It's cyclical, but we got this extract from the Q4 conference call when an analyst asked, where should the volume go to get break-even at EBITDA? They are right now making around a 10% EBITDA margin, and they said, well, in 2008, 2009, we went down to the 7%. So this reflects that they know how to do things in a very cyclical model. They are also bidding for more growth, but a profitable growth. This is an example of the last two contracts that you see in the table. They will have to invest, or they are already investing 100 million. That will yield 240 million of revenue and 35 million of EBITDA. That's what they call a 3 times acquisition multiple. Okay, when your investment is 100 million, you will get around 30 million adjusted EBITDA. As you see, 35 million on 240 million revenues is around a 15% margin. That's much higher than the 10% of the company. And what we're seeing is a trend to get better margins in every new contract. I put here the example of the Ford F-150, which is a pickup truck from Ford. They had problems with a previous supplier and they decided to change. As I said, OEMs don't have much flexibility, but if you have problems with your supplier, you're definitely going to change. So you need operational excellence to get that moat. This is very quickly our DCF valuation. You can all do your maths and your estimates. We believe we are being conservative because we're not assuming great growth, at least in revenues. We're not assuming the inflow of the tooling, so that would mean that we expect new contracts but not much high growth. That would be penalizing the model. We're assuming an 8.5 or 8.4% WACC with a 1% perpetuity growth, and we get a $39 per share valuation. I think it's much more interesting to look at multiples. Right now, Tower International is trading at 4.3 times EV to EBITDA. And the cash flow yield is around 14% in 2017 with a normalized tooling. If you look at the European average, 6 to 7 times, and we'll talk why I'm mentioning this European average, 6 times might sound reasonable. If you see the US are between 5 and 6 times. So that would yield a valuation of around between $40 and $50 per share. If you look at cash flow as well, if we get the 9.4% of free cash flow yield of American peers, we will get to our DCF valuation, which is 39, and I don't believe that 63 is a realistic valuation, at least right now, but we believe that between 40 and 50 it makes a lot of sense without the need to being really, really bullish. Okay, the risks. Of course, the sector. This is a cyclical sector, it's a cyclical business, and there's been much noise and much talk in the US about potential peak sales in the market. This is a sentence from Ford CFO who said, "This peak concept is driving me nuts." Okay, they don't see a peak. They think that the market is strong. We don't know. I mean, when you always ask companies, it's difficult to see that the market is going to crash because the CFO or the CFO of a company tells you. But common sense tells us that with low gas prices, with low interest rates, and even if Yellen pushes a bit up interest rates, they will remain quite low. So that's an important catalyst to continue at a good pace of auto sales. At the same time, the outsourcing that I mentioned before should be a mitigator to risks. Okay, it might be more of a medium-term mitigator, but currently around 60% of stamping is done in-house and 40% is outsourced. There has been a 10 percentage point switch towards outsourcing in the past 20 years, and the company expects another 10 points to happen in the next 20 years. And there's not much of a technology risk. I mean, there's been much talk about the car of the future, but as CEO said, we expect the car of the future to still have floor plans. That we think is quite reasonable. Some other risks, as we said, cancellation of contracts in the middle of the financing of the tooling, a bit of client concentration in the first three. There's not much of FX risk because although 40% of your business is in Europe, they swapped a notional of 40% of the gross debt into euros. That's about the same proportion as EBITDA. And Europe is a big thing. And of course, there's also a risk in Europe, but we will talk about it in a minute. I want to keep you listening and don't fall asleep. Valentum is our fund. What we look is for value and for a catalyst. So in terms of value, we look for high free cash flow yields, low debt, a good management, and a business that we really can understand. So Tower really met our criteria in terms of value. And in the terms of a catalyst, we viewed that these guys were delivering or over-delivering in results, that they were trading really low, so quarterly the market should start gaining confidence. Also, there are only a couple of brokers that are covering the stock. But there was something else. There was an important catalyst that nobody was talking about and that we thought that in 2016 could come into the game. We bought the stock in 2015, and we think that now is the big catalyst. CEO, Mark Malcolm. This guy comes from Ford. He holds 4% of the company, rest of management 1.5%. Mark Malcolm should have retired in 2014, but the board asked him for 2 more years. And he accepted, and he said that he wanted an incentive plan that was linked to the share price. So what has he got? By the end of December, he's got a 6 million bonus based on 3 million, it's a retention until the end of the year, and 3 million upon the successful transition plan and presenting a new CEO. So we understand that 6 million he will get anyway. But there's something else. If by the end of December, the stock is trading at $40.59 per share, don't ask me about the 0.59. I don't have a clue. He will get 5 extra million bonus. And for every dollar on top of the 40.59, he will get an additional million with a cap of 20 million. So all in, 26 million, and linked to the share price. So totally aligned with us, with the shareholders. This, in July 2014, is when they decided the incentive plan. So he was unlucky. He was unlucky because this was an all-time high of the stock. But for us, it's great, because we can buy the stock at in the mid-20s right now, and we know that he has to make a real effort, and that he's going to make a real effort to retire with a big pile of cash. This is Mark. I think he looks pretty happy. He knows he's going to cash at least 6 million bonus, but the real happiness will only come if the stock is at 40.59, and that's a 56% upside from current prices. Okay, so this is Tauro International, but, so, what can he do to get to 40.69? These are our ideas, right? But what has he done? He has delivered on results, he has continuously deleveraged the company, and he has sold assets, mainly in emerging countries. And he has sold them at good prices, because if you see the multiples, they are all around 6 times EBITDA, and the Brazilian operations were with losses at EBITDA, and they gained a 0.3 times EV sales. They announced a dividend. It's only a 0.4% yield, but it's something. And here comes the big catalyst. They announced that they are studying the sale of the European operations, and it's 40% of the business. So what's Europe? These are the countries where they operate, which are mainly Belgium, Germany, Poland, Slovakia, Czech Republic, and Italy. I've put a question mark here in Spain, and I'll tell you why in 2 minutes. We believe that the European business is a healthy business. The sector is healthy. Southern European auto sales are really healthy. Germany is also okay, a bit weak these last months, but there are no major risks with Draghi and his helicopter money. We expect interest rates to remain low and auto sales to keep trending high. They are already generating a lot of cash. They are obtaining now a 5% conversion from sales into free cash flow. They are getting a bit above of the average of the company EBITDA margins. And what they've said is that they will not sell Europe at any price. Okay? They will only sell it if they get the correct price. So what's the correct price? Well, as we said, peers trading around 6 times in Europe, between 6 and 7 times. They saw joint ventures in China, which, yes, it's China, but there are many problems in China, at 6 times. Competitor ZF paid 7.6 times for TRW Automotive, and Magna paid 8.8 for Getrack. They also paid, it's not here, but 5.5 times for a stamping company in the UK at the start of 2015. So what we believe, and we believe we're doing this in a conservative manner, is that they won't sell Europe below 5 times EV/EBITDA. 5 times EV/EBITDA is an 11% free cash flow yield. So this is a present for the guy that buys it. It's a healthy business, it's generating cash, and the sector is okay. So what's implied here is that at this level, and again, I want to insist that we're being conservative on that price, is that the US will be trading at 3.9 times the US business. We come again to the table I mentioned before, but here I've got the European valuation at the multiple you choose and the implied valuation of the US business. Again, Europe, 6 to 7 times. There are many different companies here, okay? There are more technological and less technological companies. Technological companies grow more, but their products are more deflationary. So, well, should you trade at a discount? Yes, I would say yes. But if you're able to sell at 6 times, that would be around 450 million for the total business. We are valuing it at 340, and that would imply that the US would be an implied valuation of around 3 times. So look at it however you want. You have many different angles, but look at it always in terms of cash. And in terms of cash, there's a big upside because they generate cash and they are deleveraging the company and they're really low risks. I put here what would be the implied valuation if we get the European average in free cash flow yields in 2017. This is a dream. This is not real, but it's just to give you an idea of how cheap the European business would be in terms of cash flow. The remaining business, again, would be trading at a 13% yield on EV. EV because they would cash in a lot of cash, and EV would, of course, go down. And what would they do with the cash? If they cash in 340 million from Europe, and they've got a net current debt of 300 million, they've always said that they believe that one-time net debt to EBITDA would be the perfect level for them. That would imply that after paying some debt, and with the EBITDA of only the United States, they would still have an extra cash position of 170 million, which at current prices is a 30% on market cap. So there's room for many things. Buybacks, special dividends. We don't think that they would use that in corporate moves. We don't think Tower is a consolidator or a buyer in the sector. And the remaining business again would still have good perspectives of free cash flow conversion. There are some new projects, so the conversion would go more towards 2017. But we've got an interesting growth with improving margins. So who might buy Europe, if somebody? For us, Gestamp, and this is the reason why I put the question mark in Spain in the map. Gestamp is an auto parts stamping company with 7 billion in revenues. It's a family business. Recently, ArcelorMittal sold 35% of the company to the family. And the good thing about Gestamp and Tower is that the overlap is mainly in Germany and Poland, but one has got Italy, the other one has got Spain. So we believe they quite match. Magna is a US company, a 22 billion market company. It's much diversified, but they're going quite hard on M&A, and they would have space for further acquisitions. They did one in 2015, so they could do it. But the question here is Magna, a US company, why would you only buy the European business of Tower? You can buy the whole Tower International, and you've already got your American operation, so we don't see maybe that happening only in Europe. Benteler is also an Austrian company. Well, by overlap, it could make sense. It's smaller. We will see. And then, well, there's another company that it's not here, but Martin Rea is a Canadian company that could also be an option, but we think that they're a bit too leveraged. So when? And I said 2016, but recently they said that they would take a decision of go, no go by about the late first quarter. So yes, we're late, and we weren't sure if we were going to be able and on time to present you Tower International, because late first quarter was 7 days ago. So that's why we believe that the catalyst is really on top of the table right now. What happens if they don't sell Europe? Of course, it's a bad news. So there's a downside risk here as well. The good thing is that when they announced the potential sale, they were trading around the current levels, maybe $0.50 above, around current levels. So I'm not saying that the stock will not fall. Of course, it will fall. It will give us an opportunity because the business is still sound, but it takes away a catalyst. And the good thing is that the market is not pricing in any potential sale of Europe. So very quickly, conclusions. It's a dead cheap stock. It has a best-in-class quality and management. It has company-specific catalysts. It generates a lot of cash, and it's deleveraging. Management is incentivized and aligned with us, and the key catalyst is right here. So I guess this is all the peers that we've used. You can check them when Christian sends you the presentation, and now I guess it's Q&A time. If you've got any questions, I'll be very happy to try and answer them.
Thank you, Jesus, for the presentation. One question regarding what happened when the cancellation of the contract. They have to invest a lot of capex, the launch cost. What happened when there is a cancellation? And another one question is about, is it possible to play this situation with options? There are options disponible.
Okay. Yes, that's one of the high risks if you fail operationally. It's a risk. What would happen? Well, we would have to see. We believe that they could sue the client and get back the tooling. We don't know how would that happen and what would be the timing if they would get back some of the financing of the tooling. At the same time, we believe that it wouldn't happen the first year. I mean, if you do something wrong, probably the OEM would give you some time and eventually would take out the contract. But it's a risk, and it's a risk in terms of capital inflows. You've got the 1.2 times net debt to EBITDA that I said, including all the tooling. So the good thing is that you've got there all your debt. The other question was the options. I guess you asked because well, there's a risk. If Europe doesn't come out, maybe you want to be hedged of the company. You could use a hedge going short of another US peer, but that doesn't make much sense because the risk is also very company specific. Unless there's if your risk is that there's a peak sale and all the sector is going to go down, you can short whoever, Magna or Martin Ria. But yes, there are put options, there are call options. Not very liquid, but there are. So you can hedge with options.
Are we doing microphones or?
Yeah.
Oh,
I
okay.
think it's a great idea. One quick question. The two European buyers that are most likely to have synergies are private. Some private equity buyers in the industrial space have told us that banks won't finance anything north of 2 times at this point. So how does a private buyer finance something at 5 times or north of 5 times?
Okay. Well, just one more thing that I didn't say. I mean, they are looking for industrial buyer. Okay, they don't want. When I said industrial buyer, it's a competitor. They don't want private equities. So we have to take away that. And well, above 2 times, I guess that, or below 5 times, I guess that they wouldn't be selling. There have been transactions above 5 times, as we saw there. Maybe in private companies it's different, but it's a 7 billion revenues company with banks looking to improve and to grow their balance sheets. So I wouldn't say that for a European company that there would be much problem. 5 times is not that much, especially if they're paying you an 11% free cash flow yield. I guess that would be reasonable for a bank to assume that risks.
Okay, I was supposed to speak about US, so I'm not sure about European relationships. If maybe they can bend over and take 4 times, 5 times here.
Well, we know, and from conversations that we've got to people from risks in banks, when the deal is a good company and they see the cash flow in the deal, they are happy to do it. It's very specific. I mean, you should have to talk to the bank and see if they would be willing to go into the auto parts sector with a big ticket. But
just related to that, if you don't mind, actually, can you just talk about any synergies between any of these
Yep.
this Spanish company? I mean, if it's very site specific, right? So what are the synergies?
I think that M&A here in the sector basically gives you pricing power. As we said, you're not selling technology, but and OEMs are willing to outsource. So as much power and as much volume you've got, you'll have much more pricing power. So I guess synergies are basically on pricing power and have a large client basis and trying to press on that side and improving margins.
Thank you very much.
Thank you.
Questions?
Do they have any global contract with OEM? And any risk that if they sell business in Europe, they lose some contract in the US?
No, it's a global company with local relationships. So they really negotiate locally. And to give you an example, OEMs used to manufacture different models in different parts of the world. So maybe, I don't know, the Mercedes R-Class was only manufactured in the States and Volkswagen manufactures whichever model in Mexico. So they negotiate on a local basis. And models are very different in the US to Europe. It's got much bigger trucks and cars in the US, so it's a different relationship, it's a different know-how and expertise locally, I think.
Okay. So thank you very much.
Okay, thank you very much for listening.